banks fighting back against, well, new capital rules meant to prevent another financial collapse, theoretically. Victoria, so we've got some new rules going into effect June 7th, correct? Tell us what are the rules today and what are the changes?
Well, they're not going into effect. We're going to see them.
Okay, they're being proposed.
The Fed is going to propose them. And it's the first of a couple things that the Fed is going to do on capital requirements. But these are based on an international agreement that regulators came to in Basel, Switzerland. So this first set, the key piece is they are raising the amount of capital that banks must hold and raising the quality of it. Specifically, they're requiring banks to have more common equity.
Okay. Do we know what level of common equity they're going to be required to have?
A base requirement of about 7%, at least 7% common equity. And
just to put this in context for people at home, what was the amount of common equity roughly that banks were operating with, let's say in 2007 and 2008?
The requirement was about 2%. So this is a significant increase, and it's drawn from the lesson that people learned, regulators and others learned during the crisis, which is that markets only cared about common equity when things went bad. That is what everybody was paying attention to and looking for when they were judging how healthy or not healthy particular institutions were.
Just to explain for people at home, of course, the common equity that we're talking about is really the first loss of the bank's balance sheet. When they have losses on their loans, something needs to absorb those losses before, of course, you get into the people who are holding deposits in the bank. If you get into those people, then they start running away, the banks collapse, and you have really bedlam in the financial system. But Victoria, you mentioned it. There are some people who say that this is going to hurt lending, that new capital requirements is going to reduce lending.
Well, what the banks are saying now, I mean, they've been fighting these sort of every step of the way, but now what they're saying is that, so in addition to this 7% requirement that we're going to see proposed this week, regulators are pursuing doing sort of a surcharge or a little extra requirement on top of that for the biggest banks, for the JP Morgans, the Bank of Americas, things like, based on the risk, the most risky, interconnected, large banks that we have. And they say that that's going too far, that, 7% is more than enough. And if you do this additional thing, that will cause them to curtail lending, further hurting the economic recovery.
Perhaps. Now, I wonder, could it be a prudent policy to the extent that, look, if we effectively penalize big banks for being big, if we, of course, if we increase the capital they're required to hold relative to smaller banks, then, the return on equity that's available to shareholders is lower. So, I mean, is this a prudent step? Will it actually discourage banks from growing larger? Will it encourage them to shrink?
Well, I think that is very much one of the sort of ulterior motives working here. I mean, there's the argument that the biggest banks can do so much more damage to the economy. You want to make sure they have that much more of a buffer. But then there's also this idea that maybe they'll think a little bit about whether they need to be that big or whether, any other banks want to get that big. That's definitely something that certain regulators have mentioned as sort of another benefit of this.